The Maine Real Estate and Development Association presents the MEREDA Index, the industry's leading measure of the health of Maine's real estate market, an important economic indicator for our members, their thousands of employees, and the state's economy at large. The MEREDA Index is widely reputed as the baseline measure for the health of both the commercial and residential markets. This report, being released in January 2017, covers the middle 2 quarters of 2016. This MEREDA Index is underwritten by Eaton Peabody. Thank you. 4 of Maine's industry leaders will talk about specific index components: James Brady of Brady Enterprises, Kevin Bunker of Developers Collaborative, Jim Harnden of Harnden Commercial Brokers, and Cordelia Pittman of Wright Ryan Construction. The overall index number is 93. The second quarter of 2016 saw the index reach its highest level since 2006, led by a 10% growth in the residential index. But the gains were not sustained, with a drop occurring primarily in the residential, but also in the commercial components of the index. Overall, the index indicates that recovery from the real estate recession continued, but slowed over the past year. The residential component comes in at 85, strongly influenced by a significant growth in residential permits, the strongest quarter in new permits since 2006. On a seasonally adjusted basis, there were 1,500 more permits in the second quarter than in the first, almost a 50% growth. Mortgage originations for purchase were up 3.6% over the past 6 months, and median price of homes sold grew by 2.4%. But volume of sales dropped slightly on a seasonally adjusted basis in the third quarter after a strong second quarter. The commercial component hovers at 103, which is essentially unchanged over the past 6 months. Commercial transactions, sales and leases, dropped 8.3%, but square footage and both sales and lease rates continued growth, with both price indicators up about 5%. The construction component drops to 79, with construction employment having declined by about 4,000 over the past year, a 5.4% drop, which was particularly noteworthy in the past 6 months, with construction employment down 8.4%. The strong showing in residential permits may pull construction employment back up in the latter half of 2016 and into 2017. This edition of the MEREDA Index was commissioned for the Maine Real Estate and Development Association by Dr. Charles Colgan of the University of Southern Maine and was underwritten by Eaton Peabody, with support from CBRE The Bolus Company, Wright Ryan Construction, and the Press Hotel. Thank you.
I'm Jim Brady. I'm the principal of Brady Enterprises as well as CPB2, manager of the Portland Waterfront project. We've seen some very strong growth since the recession. Things have slowed down slightly since the peak, but I'm still optimistic that there's still some room to go here in this boom that we've been having. Development has been very strong, as you know, in a lot of different sectors. The hospitality, particularly here in Portland, with tourism continue to be the biggest industry in the state of Maine, is one of the big driving factors. The office market has also tightened up quite a bit in the last couple of years, and we're starting to see some new development on the Class A office side, particularly here in Portland. And everybody's been talking about it, but the residential continues to be a very strong market. It's had its ups and downs, but overall the growth has been very strong. There's a number of different trends that are happening. On the residential side, we've yet to see it in Portland, but I think that in the future we're going to start to see some micro units. So much smaller per square foot units that are more cost effective for people to live in. In the retail front, I think we're starting to see more and more national companies starting to come back to Main Street and looking to be downtown and less so in the suburban malls. One of the trends that's driving the office development, particularly in places like Portland, Maine, is this overall trend across the country now where companies want to go back into the urban downtown areas where people can live, work, and play in the same environment. And you're starting to see that happening here in Portland, where the vacancy rate has been driven down in the office sector in the downtown areas because companies are seeing that by being downtown, they have a better chance of attracting some of the top workforce to come and work at their company. And even though that may have a higher cost of leasing and paying for employee parking, they're finding that that's actually what's attracting the best talent to the state. The dollar continues to be quite strong, and that's continuing to drive investment capital from overseas into the US markets. As that happens, these larger primary markets, the New Yorks, the Bostons, Atlantas, and Miamis of the world, investors are having a hard time finding yield in those primary markets. They're starting to look more at secondary and tertiary markets. And I think places like Portland, Maine can really benefit from some of that investment capital who can't find the yield in those larger cities, starting to look down the chain a little bit further at smaller markets that you might find here in Maine. I think we're nearing the end of the real estate cycle. It's been particularly strong, and we can't sustain that type of growth for long periods of time, so I'm actually happy to see it flatten out a bit on its growth rate, and hopefully that'll keep us from having a precipitous drop. I'm excited about the future. The office, the residential, the retail, and the hotel sectors continue to do well here. We have some supply coming in all of those sectors, and hopefully we don't get oversupplied, and that the MEREDA index stays fairly flat to slightly increased so that we don't see a huge drop coming. We hopefully have a little bit of room left in this runway for some optimistic real estate investing for the years ahead.
My name is Kevin Bunker, and I'm the owner of Developers Collaborative in Portland. I think we are really at the top of the market. We've got 5 factors that have really combined all at the same time to make the market really strong. First of all, coming out of the Great Recession, we have a lot of pent-up demand. So there weren't a lot of units getting built. And as the economy came roaring back, which is the second factor, there wasn't enough units to satisfy the demands. Then as developers looked to build, what they found was they had very competitive construction pricing because a lot of contractors were out of work, and you combine that with ultra low long-term interest rates. So it's possible to get very cheap financing and very cheap construction. All those things combined to be a very favorable climate for development. And then at the end of the cycle, what you've got is very strong track record of investment sales because real estate has gone up a lot as cap rates have gone down. Therefore, investment sales have been very high for some product that ordinarily would never have sold for that much. So you have a lot of incentive to develop new product, and that's led to a lot of developers coming online, a lot of planned units coming in waves. The question just is, when will that demand be satisfied? And I don't think anyone really has the answer to that yet, but it appears that rents are leveling off, sales prices are leveling off, though not dropping yet. So it seems like we're at the top. There's a lot of new ideas that tend to get recycled and become in vogue, and some of them are in response to scarcity. For example, micro units. People will talk about doing smaller urban units. Well, the reason they're doing that is not because people really want less space, it's that they'll accept less space to live in a city, and land is so expensive that you can fit more units into a smaller space. So that's something that's a response to high land prices in the city. It's no secret, senior housing isn't new. Everyone knows by now about the baby boomers and the demand for senior housing, and people want to age in all sorts of different ways and places. But there hasn't been lots of different ways that's been able to be delivered. Senior housing is generally confined to a few types. I think innovation in that sector is starting to happen. My company is certainly working on it, and I think as that continues to happen, you're going to see a new variety of products tended to the 55+ market. So as the market is plateauing, I think the market's still good, and I think it's really still possible to do well in real estate, even with new development. But I think it becomes more important to have an advantage and not just do a vanilla project that everybody else is doing. So one thing you could do is have a superior location. For example, if you're right on the waterfront in Portland, you're going to do well in any economy. Another example is land prices being really high right now. Maybe you have a really low cost basis in the land or can get it upzoned, so you have less dollars in it per unit, or maybe you've owned it for a long time. That can be a competitive advantage. Or maybe you have an idea no one's had. Maybe there's a niche market that people aren't serving right now. Maybe there's a way to do a project that fits a little piece of demand that no one's really targeting right now. And that's a good way to keep yourself insulated from the ups and downs of the general economy.
My name is Jim Harnden. I'm president of Harnden Commercial Brokers. The commercial sector has grown a little under 2% since the end of 2015. Transaction volume has been steady in all 3 sectors of office, industrial, and retail. The trends that you've seen in the commercial index have been the velocity of transactions over the past several years. Vacancy rates have had a steady trend downward, and the leasing prices and sale prices have had a steady increase. And that's been pretty consistent over the last several years. In terms of the real estate cycle, the peak in pricing probably happened in 15 and 16. And I think with the interest rate trending upward, that will have an impact in regards to sales prices on a negative basis. What you've seen from a leasing perspective is we're probably reaching a peak in regards to pricing on leasing right now for existing product. Pricing will be significantly higher than what current rates are today. The multifamily market has been fairly active over the last several years, and that will continue to be active, and I think you're seeing new construction now that will continue as well over the next several years. All sectors, at least in the office side, the Class B sectors have been doing well, the Class A sector has been doing well. There has been, and there probably will be, a bit of a flight to quality that you'll see, especially with the new product that I think will come online in late 18, early 19. Looking forward into the office sector for 2017, you will see several significant transactions actually signed in 17, with construction happening in probably 18 and delivery in 18, 19.
I'm Cordelia Pittman. I'm the Director of Pre-Construction Services at Wright Ryan Construction. The way we would use the MEREDA Index to inform our business planning is really to sort of as a global and overall perspective. Wright Ryan has both a commercial construction and a single-family homes business, so all aspects of the MEREDA Index is very helpful to us. One of the pitfalls that we see that could impact growth would be the labor shortage that we see, and this is something that Wright Ryan experiences every day. So while the MEREDA Index for construction jobs actually dipped down slightly, it's hovered around the same number for quite a while. What we're finding anecdotally is that a large number of subcontractors and contractors have job openings, and they've stopped advertising because they can't find good candidates for those jobs. And what we also hear anecdotally from subcontractors is, if we could find more good quality candidates for these jobs, we could take on more work. So I think that that's definitely a problem that Maine has to deal with. Clearly, the costs of construction are rising enough in Maine that it becomes palatable for a group from Massachusetts to come here and do work. My prediction is that if we don't amass more of a labor force in Maine to fill these jobs, this will happen more often, pushing the cost of construction in Maine up, which will in turn mean that the wages for these subcontractor jobs will also go up, which may be the point at which more people flood into the labor positions in the Maine subcontracting market. That's my theory. We all know in Portland, condominiums have been a very popular product. Have we reached the saturation level yet? I don't really know. We know that there are projects ongoing and there are more proposed projects. Areas where there definitely is still a great deal of interest is Southern Maine still has the potential for more hotels. We know there are more planned. The healthcare market definitely has some very, very large plans upcoming for a great deal of construction. And also in both public and private higher ed levels, there are a fair amount of construction planned and actually ongoing at this point in time.
This edition of the MEREDA Index was commissioned for the Maine Real Estate and Development Association by Dr. Charles Colgan of the University of Southern Maine and was underwritten by Eaton Peabody, with support from CBRE The Bolus Company, Wright Ryan Construction, and the Press Hotel. Thank you.